Greetings, my fellow Fannie Mae and Freddie Mac warriors. For this morning and for today, I would like to explain several things what is about our subject. It is about junior preferred shares. So I will try to answer the few main questions, and I will try to explain few main concepts. So first, junior preferred shares are type of the debt that company can issue the bonds, but it can also issue preferred shares. Preferred shares are basically something between the bonds and the common shares. So they're special type of the security where the company give promises as a bond that they will pay the interest for the money they borrow. But in case of the restructuring or liquidation of the company, they have the right on the equity. So basically in the capital structure, the bonds are the highest level, then preferred shares, then it goes the common shares in case, but all of that is case of liquidation. They also have the first right of the first dividend. So basically in case the company needs to pay the dividend, it needs to pay and don't have enough money for the dividend, the first it needs to pay to the preferred shares, and then after that the leftover money is paid that goes to the dividends is paid to the common. So what does it mean for Fannie Mae and Freddie Mac? Fannie Mae and Freddie Mac had for a long time that had and almost always almost every company have the preferred shares, and they have issued a lot of preferred shares before the crisis because they needed the money, they needed liquidity in 2008, and they did issue a lot of shares in the amount of $20-30 billion. But they issue them, they pay like dividends for a couple of years, and they right now those shares in last 20 years they are rated as junk. So basically CA rating or something like that. So but it is very bad rating. It's like worthless shares. A lot of us, even me, did own those shares, and what was the reasoning? In case we didn't know that will company go bankrupt, will it be liquidated, what will happen with the company? So my reasoning, and basically a lot of other people reasoning, was okay, in case that company goes bankrupt, I will invest that amount that if the preferred shares are paid as the liquidation value, that I recoup my money that I have invested in preferred shares and in a common. But what happened last year, we definitely know that company don't go into bankruptcy, liquidation, reconstruction, whatever. So there's no reason for me personally to own them anymore. Another reason for me not wanted to own them is because they have limited value that they can grow. They cannot grow more than the face value. The face value is that what is the value of the share that is written on the prospectus. Very often it is let's say they have like $25 and $50 share, and there's like 50,000. But let's stay on 25 because they're the most common. FNMA S and FNMA T. So they have the face value of $25, and in case of liquidation you would get that 25. Also, what is important for those shares, because they were issued by very important company, and the company had good background, they issued them at par for $1, and you can check that, and you can see that in 10Q of Freddie Mac. On Fannie Mae 10Q, it says that it has the face value or the stated value. I'm not sure one of those two, but putting the face value and stated value in front of the preferred shares is actually happens when the at par is 0. And I actually also found one of the documents where it says that Fannie Mae and Freddie Mac, the Fannie Mae issue so many preferred shares with at par value 0, and also common shares with at par value 0. For common shares, it is normal to have at par 1. But for the bonds and for the preferred shares, for the debt, that is the value of that bond. So in case that company want to pay off the debt, and for example, like company have the, let's say, FNMA has 8% coupon, and on the borrowed money, in case that they pay dividends, the Fannie Mae needs to pay 8% for those dividends and for those preferred shares, in case that they pay dividends. So last 17 years, we didn't have the situation that we need to pay the dividends. And company, so what can happen? What can happen that company see that 8% interest is too large, and they know that they can borrow the money on 3%. And because why I say 3%, because like certain companies like Apple, I just like look last night, like Apple have the bonds that they pay on 3 and 5% interest rate. Let's say 4, just for matter of argument. Let's say 4%, and we know that FNMA is 8%. Is 8% preferred share. So company needs to pay 8%, and it can borrow on 4%. If the cost of the capital is too high, they will issue the bonds on 4%. I talk about normal case, and pay off this. Situation with preferred shares of Fannie Mae and Freddie Mac is that call value and the at par value is $1. The biggest question there, does the government have the right to override the contract? That is the biggest question over there. If it has the right to override contract, and to say the contract that we have with common or preferred shares is that company has contract with the common and preferred shares can be overwritten. What does it mean? That government can create the warrants that is overwritten the contract, because they can create the warrants by themselves, and they plan to do it. So we know that government don't respect the contract in this case. They can also overwrite the contract of preferred shares. Do they overwrite the contract of the preferred shares? I can say yes. Why? Because they did overwrite the call dates. The call dates for the preferred shares were like all over the year. It was in May, it was June, May, February. If you look at the prospectus for each, it states what is the call date. And after that, for example, FNMA was like, let's say March. I think but it was not December. FNMAS was December, but FNMA was, let's say, March. And on every 5 years, they can be called. By changing the call date, it is actually overwriting the contract. You cannot just take and change it in normal case, but because of the conservatorship, they can. And they did. If you go to the Schwab website and look at the junior preferred shares, and on my video on the Twitter, when I post this video, I will put the link for my post of the. I will put in the description link toward X post and in a reply of that text post will be the document that it is called on December 25th, 26. So they did override the contract. As they can override the contract for the call date, that means that they don't respect the contract. And in the contract of the prospectus, it says that they need to be paid face or stated value. But if they override the contract for the call date, that means that they can. So thus the government is ready and willing to pay if they have the capability to override the contract. The face value, that is says on a contract, the market value, that is 50% of the value of the stock, or the at par value, because it is absolutely normal scenario for the company to pay off the debt at par value, and that is happening. So the government has the option. So if the government has the option, will they pay 1 billion, 15 billion, or 30 billion? And we saw that they can choose what they will do. That is number one question. Number two question: who is paying and who is getting that $1 of the preferred shares in case that they do to pay off at $1? If I'm the company, I would pay like $1. So who is paying? The company is paying out of its funds, and as we know, on the books the company has the money. It is like $1 billion. Okay, it's a lot of money for us, but for the company of the size of Fannie Mae and Freddie Mac, it is $1 billion is nothing. So they plan to I think that they plan that they will pay off those $1 billion and clear that debt from the books. Who will get, so in case that you own junior preferred share, there is large probability that you will get $1 for that share that you paid 15 in a like up to end of the month. You may get market value, and you may get, I don't believe that you will get the stated or face value, because as I said, like, they override the contract. They know that they don't have to respect the contract to go to this, so they can do either market value at par or at par. So it depends on the scenario. And how does that affect the current junior preferred and common price? For junior preferred, they will get, let's say, the market value. Let's say that they will get the, but the best case scenario for junior preferred shares is that they are paid face value. That is $25. So this is like 12. The best case scenario is that in next month, January 25, they double the price, and the government pay them at 25. That is the best case scenario. But as I said, like, they already, that is the best case scenario. The normal scenario would be that they are paid either at par or the market value. So let's say that you have the money, and the most it can is to double the price. The most you cannot, it cannot. Whatever they do, they will not pay the dividends from the before, because they are not redeemable, not convertible. So they will not convert them to any other stock because they're non-convertible. So they can get the money. How much, that is the question. But as I said, the most is double, the less is at par. And how does that reflect the price of the common share? It creates better balance sheet. It remove the problems that common shares, Fannie Mae and Freddie Mac, may have. So it gives us the better value, and we know that the company, the money that it has, don't need to go for that. So it is actually very good for common shares. Like if you take and raise $30 million debt from the company, it is a boost for the common price of the common share. And in case later down the road, in case that company needs to pay the dividends, it does not mean needs to put on a side $1 or $2 billion for the dividends, because the dividends are not happening no matter what. Why? Because the call date is moved. The call date is, they changed the call date. They wouldn't change the call date unless they plan to call it. They wouldn't break the contract, which probably they have the right. They wouldn't break the contract in order to change the date, just to for fun, that everything is looking good and nice on the paper, that everything has the call December 25th, 26th, 2025. So they wouldn't do that unless they can plan to redeem them and call them. So, but reality is, in case that I need to invest my money, as I do I want to invest in the security that has the downsides possible in next month to hold the value, or only, I'm to say only to double in case of we have IPO? That is one scenario. So we have like preferred share scenario, market at par, and face value. So one of those three scenarios. For common shares, in case that we have IPO and current price is $11 and we saw it cannot go down, but in case that we have IPO, let me ask you, how much does Fannie Mae and Freddie Mac have the value in case of we really have IPO? Will it double? Will that $11, in case we have openly IPO where the debt is removed, where the senior preferreds are cleared, will the price of the stock go double? Will it go triple? Will it go 4x or 10x? If my money is invested and I say my money, the stock that I pay now, $11, is possible not to go only 25 or to double. It can go 3, 4, 5x, almost for sure, because all the securities, the insecurities are removed. So where my money is better to be in? For me, my personal case, it is in common stock, because the risk is basically the same. There's no bigger risk. Actually, at this point of time, I think the risk for the preferred shares is even bigger because of that call date than it is for common. We know that they will not receive the dividends. If they have the call date December 26th, 2025, and they change the dates, they're not getting the dividends. So write off that story. For common shares, will they survive? I think it is unquestionably yes, because on the website of Fannie Mae and Freddie Mac is publicly listed the tickers, the symbols for the stocks. We know that that number of times a representative of the government said that the company has the ticker and it is traded but over the counter, so that means that those stocks stay valid. So they will not wipe us out. The junior preferred shares, they are called. So there is also question, because in the documents it says that they need to receive the notice 30 days before call date. I have personally seen a number of people saying you can go on the Schwab website, on a couple of other brokers. We found on the Schwab website, so but that's not the only place where it is. And there is a notice that those preferred shares are called. And so they did receive the notice. Maybe they didn't receive the email, they didn't receive the letter, but it was publicly posted on the brokers' websites, and that is considered as a notice. So there they will be redeemed. So if you own them, it is up to you. It's your money. I'm just the guy who see the like the fire and yell the fire. If you own them, I did personally what I have done. I took and sold, like, let's say, a couple of months. When I realized, like, when at the moment when I realized how much money I lost, potential lost, I did lost, by staying in the preferred shares instead of moving to the common, the full amount. And then I sold my preferred shares, moved to the common. But as I mentioned during the video, for me as a that was my case. So I said, like, for me the risk mitigation was put some part in the preferred in case of liquidation. It will cover my investment, and I'm good. But the situation changed. If situation change, I change my. If situation change, I change my action, and I took and sold it in order to put the money where it can grow more. So that was my decision. And when I sold personally, I sold. Let's say a couple of months ago. I know that FNMA, the shares that I did own, was around 15, 16, and I was paying Freddie Mac. I bought Freddie Mac for 13.33. I like nice numbers. So I want to say, if you make the decision and move it, you will do it better than I did. If you sell now and buy you will be able to get more. Also, what I want to say about the preferred shares and conversion, in case that you think about moving them, is that if you do it, you need to pay the capital gain. And the question is, in case that, let's say, for example, let's think up the numbers. I invested and I paid my FNMA. Let's say I invested, let's round it, 10,000 shares. I bought them at 5 and I sold them at 15. Just to be even numbers. So I paid $50,000. I sold them for $150,000. I made 100,000 capital gain. On that $100,000, I need to pay 20% the tax, the capital gain tax. So I made 80,000. In case that I invest 130,000 in the stocks, at what moment I will get back with my investment. So I have 130,000. I can buy 12,000 common shares. When they grow more than 20%, that means from this point, from 11, when they go to 13, I will break even regarding the capital gain and the amount of that I have, that I wipe out the capital gain tax that I need to pay because of the conversion. So the question is, for you as investors, and for me what it was, do I want my money to be in the stock that is that have the market value 13, can go to 0, and very unlikely it can go to 25? Or do I want to invest, to convert it, to move to common stock, and to pay the capital gain, and to go from 11 to 13 to break even, and then after that to 26, or more, to make the money? I think that personally, at least that was my decision, that it is better investment in common stocks. And because it will allow me and give me opportunity to create bigger value and bigger return on my investment. So stay well, think about it. Maybe this is your biggest investment in your life. If not, it can be, but like we buy the phone, we buy the watch, and we read the reviews, we put the calculations, we think about that. And for this big investment, like learn and educate yourself, and like put at least the amount of the research that you would put otherwise in the not investment of that weight, but like if you buy the car, you will read the review, you think about it. So think about this too. I did, and this was my decision.